Digital Economy Lab lunch seminar series. We're so happy to have with us today Professor Lynn Wu, a tenured professor at the Wharton School, who's been doing work on IT, AI, analytics, looking at firm innovation, business strategy, social media, predicting economic indicators, and a wide variety of related research. She's one of the rising stars in the field, also a former PhD student of mine when we were both over at MIT. She's published widely in economics, management, and computer science journals and been featured in a lot of different publications like Business Week and the New York Times, Forbes, The Economist. And today she's going to be talking about innovation strategy after IPO. So welcome, Lynn. Looking forward to your talk.
Thank you so much, Eric. It's a pleasure to be here. Should I start sharing my screen or? Okay, great. Now let's see if I can, I'm still Zoom efficient.
Zoom savvy, yes. This is the hardest part of the seminar, getting the slides to share.
Exactly. Yeah, after all these months of virtual.
Looking good. Yep, we got them now.
Okay, great, excellent. Thank you so much for coming. I'm super excited to talk about this new paper with Bowen Low. He is a professor at UConn and Lauren Head at Wharton. I want to talk about how data analytics can potentially mitigate some of the post-IPO decline in innovation.
Thanks, Lynn. Actually, I forgot one part of my job, which is to remind everybody that we welcome your questions and comments. The best thing to do is just put stuff into the Q&A function, and I'll look for them. For the first 40 minutes or so, please focus on clarifying questions, and I'll pass them on to Lynn. And then the last 15 minutes or so, we'll have a broader discussion about this topic, but I'll be monitoring the Q&A for your questions and comments.
Excellent, thank you. Okay, so, IPO, I'm sure this is a topic that's going to be very familiar to you people at Stanford and Silicon Valley at large. When firms go through an IPO, I think timing is primarily related to the overall market condition. And this is mostly due to, having a higher valuation can greatly facilitate future acquisitions. However, the effect on innovation has rarely been a major concern when firms try to decide when to go through an IPO. However, recent research have shown that IPO could have a negative impact on innovation, especially the quality of the innovation that's being produced after IPO. And the main goal of this of our project is to figure out whether if we're still true, and to also to see how modern technologies such as AI and data analytics at large can potentially mitigate some of these negative consequences for firm innovation after a firm has gone through an IPO. So theoretically speaking, it's really quite unclear whether an IPO could have a positive or a negative effect on innovation, right? So on one hand, IPO can be great for innovation because the cash infusion after an IPO can allow firms to invest heavily in R&D. And the capital provided by an IPO could increase incentive to engage in risky long-term projects, because it can eliminate potentially risk in bankruptcy or risks from having a failed large-scale project. So unfortunately, that wasn't supported empirically. And also the reputation effect from IPO can also engender lots of intangible benefits. For example, having gone through a successful IPO, you could more likely to attract talented, innovative employees, and you could potentially strengthen the bargaining powers with the suppliers, or signaling greater qualities of your product to consumers. But on the other hand, IPO can also hurt innovation, and various literature in corporate finance, marketing, and strategy have documented that IPO may actually hurt innovation, and these research has ruled out that these factors are not related to accounting choices of life cycle of the firm. For example, maybe firm chose to capitalize innovation first before developing more, right? So there were actually three main factors that contribute to the innovation decline after IPO. Like the first, the IPO event may force firms to focus on short-term financial goals. And this would discourage risky investment and causing firms to target innovation that have a very near-term payoffs. And this is further compounded by the fact that it's just really difficult for external investors to evaluate long-term innovation because that will require deep expertise in the subject area, and many investors may not have it. And this could further prevent innovative firms from suitably rewarding these long-term innovations and investments because we cannot see them for a long time from the investment. And the second factor is disclosure requirement, right? Public traded firms just face a much stronger financial disclosure requirement than from the market than private firms, right? And this can come from mandatory stock exchange disclosure rules, or also from analysts trying to demand information so they can properly evaluate the firm. And this type of disclosure reduces the potential rent of innovation, right? And the combination of public scrutiny and potential spillovers of this innovation to these competitors, especially sensitive information, would further reduce incentive for firms to innovate, especially those risky projects that may take a long term to a certain success. Lastly, incentive of the innovator can also change after an IPO. So the managerial incentives could also shift toward more incremental innovation than radical ones, right? So first delusion of ownership may lead investors to avoid risky projects when the reward is shared by a much bigger group of people than when the firm is smaller. And it's also hard for owners to monitor managerial performance to distinguish those between poor luck or actually bad management skills for those long-term risky innovations. And furthermore, IPO firms tend to have difficulty retaining these key innovators because they may prefer private firms where they may receive a greater share of the pie from their innovation. And this even when this inventor stayed after IPO, retention could be a big problem as new opportunity arise, a spinoff, for example, that would allow them and that would enable them to pursue innovation without a constraint of different ownership. So these are all three main factors: short-term financial pressure, disclosure requirement, and the managerial incentives collectively can actually hurt innovation after a firm has gone through an IPO. And let me show you just a graph to what do I mean. This is a replication of an existing paper. We'll look at 4 citation of the patents before and after a firm has gone through an IPO. And the comparison is really at the 0 when a firm actually has gone through an IPO. So this bar here, you can think of as IPO date, and this is the bar on the left-hand side is the relatively magnitude of 4 citation relatively to the IPO date, and this bar on the right are the citation change relative to the IPO date after a firm has gone through an IPO, right? So you can see before an IPO, it's like hovering around 0. All of this magnitudes are not statistically significant from 0, right? But if you look at the subsequent years after IPO, like 1 year after, 2 years after 5 years, actually quite a decline in the quality of innovation measured by patent citations. These are measured by those who actually cited your patent, okay? So this can be a big problem for firms after IPO if innovation decline drastically over time. So how do firms deal with this innovation decline then? So a lot of firms actually just choose to remain private. And they do this to avoid Wall Street's obsession over quarterly earnings or the Sarbanes-Oxley requirement in accounting. And some firm has gone through drastic financial restructuring to protect their long-term innovation. For example, Dell has completed a leverage buyout in 2013 so it can focus on long-term innovation more. And IKEA has chosen to remain private so we can take a longer term view on innovation and business development. We also seen in drug discovery, Roche has remained private for a long time. Even today, it's mostly private-owned firms, and they do that to have a long-term view on innovation. Okay, and that's very costly because if you don't go public, you cannot access the market. I mean, the capital from this market. And if you go through this restructuring through leverage buyout, that's also very costly, very challenging to do. And so with the rise of this AI technology, data analytics technologies, we are trying to see, can these technology help to alleviate this pressure, right? So if there's like a technology solution that can actually alleviate the decline in innovation after an IPO, that could be a great thing, great strategy to do, because it's really hard, as research has shown, it's really hard to change culture, incentives, organization structures, and even the technology is not a perfect solution. If it can help to some extent, that will be a great alternative for the firm. So of course, as a person who studies technology, I'm really interested to see there's a technology solution to some of the difficult problems in the world. So we're particularly interested in the recent development in AI and also analytics, because in particular of their ability to generate recombination in innovation. This is by using existing technologies and put them together in a new way. And that new combination of innovation of existing technologies could help us find solution to an existing problem. And we've seen that in Halocene, which is the 2019 AI helped a group of MIT researchers to discover this new class of antibiotics. I'm sure it's probably familiar to lots of people in this audience. And it was an incredible feat, because identification of a new class of antibiotic is really, really difficult. And a few years ago, actually, Wall Street Journal has ran a feature article about the difficulty in the space of finding a new antibiotics. And firms, big and small, have failed to find them. And these firms either went through a bankruptcy, or in case of large firms, they had to write off billions of dollars of investment. So finding this new class of antibiotics, Halocene, is a major breakthrough. And AI was able to help, because it can find patterns in data, especially hidden patterns, and iterate through many different combinations of chemical structure to see which one has a desired property. Desired properties. Recently, just a few, I guess last week, right? Or just maybe 2 weeks ago, AI made a breakthrough in a protein folding problem. This is it's a really big deal in drug development, because it's a really hard problem to solve. And AI can help this process by searching a much bigger space to find all possible combination and quickly assess their value. Okay, and in the realms of arts, we see that, if you look at arts that AI has created, it's often not a arts designed from scratch, but it comes from combining several art pieces together to form a new art and find optimal combination that appeal to aesthetics. So in this example, just a beautiful photo of somewhere in Europe, and then you put it together with Van Gogh's Starry Night, and then you got a Starry Night themed photo, and that's something you could potentially hang your living room wall. So these are all examples of AI and data analytics driven innovation, and that's primarily help finding a new combination of new technologies. And we have written some of this in our earlier work. So we're trying to see, well, can we use data analytics to help with this post-IPO decline innovation? And that's also our research preview. We asked us that question, and the answer is yes, but it depends. And so we look at, so what specific type of innovation? And we find that, just as I explained earlier, because data analytics are really good at finding new combinations, and indeed we find that data analytics can help these firms to find new combination of existing technology, and that can help firms to mitigate some of the post-decline innovation. And we also, more importantly, looked at the mechanism, like see which of the mechanism that analytics can help the most. Remember earlier I mentioned that there's 3 factors that are responsible for the post-IPO decline in innovation. Number 1 is short-termism, is the focus on short-term financial gains. Second is accounting disclosure, and lastly is managerial incentives. And we found that data analytics can primarily help mitigate the fact of short-termism and disclosure, but we don't find anything on managerial incentives. So we'll go through each of them in detail in the next couple of slides. So first, I'm going to talk about the measure. How do we measure data analytics? So we use 3 types of data sources to measure analytics. We have full text resume data for about 20 years, from 1988 to 2007. And then we all have job review data and on job post data. that covers all the way from 2008 to 2019. And we use data analytics skill just simply the number of employees with skills in data analytics. We can use words such as data mining, analytics, regression. We can also, or we can use job titles as data scientist, data engineer, et cetera, et cetera. To give you an idea how exactly we did it, this is the taxonomy we used. So we cover general data analytics skills such as business intelligence, and data mining, data warehousing, okay? And we also focus on more specific system-related analytics skills, such as Cassandra, cloud computing, distributed system, Hadoop, etc. And then we also look at some algorithm and methodology-related keywords, A/B testing, such as A/B testing, machine learning, neural networks, NLP, pattern recognition, et cetera, et cetera. Right? So this is a broader set of analytic skills that cover some of the recent advances in machine learning and AI at large. And then we also classify a set of words that just specific AI skills. And this is a set of words we use, and is also has been vetted by by others. So I think Brynjolfsson has created a series of papers on how to identify the AI skills. We did our own way, and we matched against theirs. It's pretty comparable to what they find. So these are the words that are related to data skills identifications. We used word2vec, LDA, neural networks, deep learning, convoluted neural networks, et cetera, et cetera. So these are, so anytime we have job posting, you have these kind of words, we consider that the job posting is related to AI skills, and we count as that person has AI skills. And we do that same thing for job reviews and also in resumes as well.
So Lynn, can I ask you this question about the data sources? So I think I understand the resumes, those are the resumes, and you match them to the people in the company, and the job postings of the people in the company. What are the job reviews? What's that? What does that mean?
It's a Glassdoor.
Okay, Glassdoor. So yeah, okay, got it.
Yeah. So it covers both demand side and also the supply side, right? Job posting is more about, hiring, and the job reviews are people who are already at the firm. So hopefully that will give us more comprehensive, metric on the overall demand.
Gotcha.
Yeah. Okay, and this is the trend of the analytics over time. So we measured it up to 2013. So you can see it's really growing quite a bit. Because so you can see that it dipped a little bit during the Great Recession, and it kind of ramped up quickly shortly after that. And we also measured AI skills for more recent periods. We see again similar patterns. We actually look at a bunch of AI skills like machine learning, expert system, etc. And expert system is pretty flat, but machine learning is the one that's really driving the growth in AI skill trends. So again, we see, especially in the last couple of years, a big increase in use of AI skills. Okay, to measure innovation, okay, we use the US patent database. I know patent is not the comprehensive measure of innovation, but that's what we use, and it's because it's pretty common to assess the innovation across many firms, across different industries. But of course, we understand some shortcomings of patents, and then we acknowledge that in our project. So we use, for innovation outcomes, we use existing citation-based metrics. So these are classic ones that you've seen before potentially. For example, originality is how widely you cite others. So it's basically your citation list, the reference list of your patents. Let's see what whom you cited. And generality is how widely others have cited you. So basically looking at who have cited you, thinking of Google Scholar page, how many people have cited you, and that will be a generality metric. And each one is like a Herfindahl index, a function of Herfindahl index. If many people have cited you, and many different papers have cited you, then your originality and originality is going to be high. If many other people cited you, especially from different industries, different classes of technologies, then your generality is going to be high. But these are citation-based metrics, and we want to be a little bit more fine-grained in our measurement to see what type of innovation outcomes can we define that closer match what what analytics can potentially provide. So what we did, we actually classified innovation further into 3 distinct categories based on the 3 different categories. Number 1 is like a radical innovation. It will be the first of its type in a patent class. Like, when patents have a bunch of technology classes, if this patent is the first one in that class, we consider that to be a radical innovation. We also look at new combinations in a sense, like assuming
so
we have
clear, that's radical for them, but the patent office already has that class.
Exactly.
Okay. So it's not new to the world necessarily, but it's new to
we actually do both. We actually look at new to the world and also new to you as a firm. Yeah.
Okay.
So in this case, assuming we have, this is all the existing technologies that we have, like A, B, C, D, ABC, AC, and BCD. So ABC is like combination of existing technology, ABC, right? So new combinations are a new combination of ABCD that didn't exist before. It's not, CD is not any, or AD are not any part of this existing combinations. And we also look at incremental combination and just like a slightly improved version of A or B. That's
really cool. I really like this this taxonomy here. How often does the patent office create new patent classes? Is that like, would that be something that's new to the world? How do you distinguish something that's new to the world versus new to the firm?
Oh, so basically we look at basically all the patents you have, and then this is the first time you create like a patent in saying, before you only have patent in category A, B, C, and you never had a patent on D before. That will be new to you, but D already existed, right? Right. But let's say a new patent office create a category X, and the first patent classified in X, that will be the radical innovation. That will be,
so the patent office occasionally creates a whole new category.
Exactly. And then whoever owns that patent created a radical innovation. Yeah.
It might be worth breaking out those 2 different things. They seem kind of different to me. Which
ones?
The 2 versions of radical innovation. The one where it's new to the firm, but maybe your competitor's been doing it for 20 years and you're kind of like copying them, versus if it's new to the world, like you've done something that no one's ever done before.
Yeah, absolutely. It's actually 2 by 2. A 2 by 3 is like a local version of this and a global version of this. So global radical innovation, a local radical innovation.
Right.
Local will be, So I'll show you some of the breakdown, because that's like creating 6 different results, and we have all of that in our paper, but I'm going to show you a subset of that result today.
Okay.
Yeah. But that's exactly what we're trying to figure out, because sometimes, analytics can help you discover things faster, and that could be greater for local radical as opposed to global radical. Okay, so I already explained this, but I'm just go through this example. So this is a patent for Amazon's one-stop shopping, and this is the citation list, right? These are all the patents that this particular patent has cited. Okay, so here we can think of, so here we see that they give you the class numbers, right? So we can see, okay, this is a patent combining 3 existing technologies together. So 380, I believe, is cryptography. 385 is digital processing method, and 705 is digital processing method for financials. So it's combined 3 of them together. Okay, so obviously, if you create, like, say, the first time you talk about CRISPR technology, maybe that's a radical enough to be aware in its own technology class. We also create an alternative one, which is looking at novelty of words. So here we look at the abstract of the patent, and we look at the age of each word, right? So if you're a patent that's had CRISPR for the first time, and then that word age is very, very young to you, so you have a very high novelty score as opposed to the 200th patent that use the word CRISPR, right? That's kind of the distinction. So we really have 2 ways to measure radical innovation. One's based on patent class, the other way is more NLP driven, looking at the word age of the abstract in this patent.
And you just do it at the word level, not at n-grams, is that right?
Not n-gram, yeah. But I just saw Sarabana's job to that. Maybe we can do that, something like that too.
Yep.
right. So we did an LDA version of this, but the LDA actually did not provide anything newer than this novelty. So we always use the just simpler methods when the complicated method doesn't add much.
Yep.
At least in LDA case. Okay, so these are the how we measure innovation classes: a new combination, and radical innovation, or incremental innovation, and that can be measured relatively to the firm, also relatively globally to the entire world. Okay, so IPO data is it's all public, so we just create a binary variable. Is it public or is it private? So it's 0 before IPO and 1 after. It becomes 1 after IPO. And we also create a bunch of financial characteristics. We control for R&D. Basically, all the characteristics that have shown to be related to innovation, like R&D, patent stock, VC stock, venture capital investment, if they have any, and assets, and employees. Okay, and first we just do a very simple regression. We just look at the innovation outcomes. Okay, we look at the citation-based metrics, originality and generality. These are the ones that's already being done by the existing studies. For example, in Weiss and Moorman is in marketing, and also other people in corporate finance and strategies. Okay, and then we added our own metric of innovation. This is number of patents that are a new tech, like radical technologies. Is it a new combination, or is it a reuse? And we can also do that relative to your own firm and relatively to the global world. And here we just added public, which is IPO. We add data analytics, and then we look at interactions between data analytics and IPO. This is the beta 3 is our point of interest. We're going to examine to see whether data analytics can actually help IPO firms improve their innovation outcomes or not. I'll afford a bunch of endogeneity, with this formulation. I'm going to go into that in a couple of slides, but I just want to show you the raw first results, looking at this simple relationship directly. Okay, so this is the result. We look at 4 specifically. We look at new tech global, like the tech that's new to the world, and then we look at new tech that is new to you, but not to the world. And then we also see the new combinations, like is this a new combination, new relatively to you or new to the entire world? But here we look at just what new to you. We also look at reuse, like basically how whether it's an incremental improvement of your own technology or not. So these are the, so we can do all 6 of them, but I found some category have pretty high overlap, so they have a high collinearity. So we didn't use them all of it in our analysis, but we did. They are all available in our paper. So you can see, interestingly, if you look at public, actually the one that got the most reduction is actually the new combination relative to you. So this is encouraging. That means that's exactly the type of technology that 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 data analytics are purported to help. That we've shown in our prior papers. So that gives us some confidence that maybe data analytics can help with this new combination of existing technologies in a new way. Okay, and indeed we have found if you interact with data with IPO or going public, and it has indeed mitigated that effect. So if you look at the public is negative 0.299, and having data analytics, like having 1 standard deviation increase in data analytics skills, almost mitigate all of that negative effects in going public. So that's pretty interesting. So it seems like data analytics can particularly help post-IPO firms in producing new combinations. And that's precisely the innovation that seems to be declining for firms that have gone through an IPO. What's interesting is that we actually find that if you use data analytics to do new technology globally, again, these are technology you've never seen before, maybe there isn't any data on this technology, you actually may have a negative effect. Basically, data analytics didn't help you at all in this category of technologies. Maybe because data analytics can't help you at all, and you misuse that resource in data analytics to help you generate new technology, global technology, and that actually may not be cost effective. Whereas comparing to a new combination of existing technologies, and data analytics can provide a great benefit. So it also helps with the endogeneity, because if you think of some other factors that's driving adoption and analytics that has nothing to do with innovation, and we should see the directional consistent metrics across all different type of innovation. The fact we see different signs on different type of innovations gave us some confidence that what we're seeing is not just a artifact of endogeneity issues.
So yeah, I agree, Lynn. That's great. It's very consistent with what you'd expect data analytics to be helpful and not helpful to. But I just want to be clear. This is that type of innovation post-IPO versus compared to pre-IPO, right?
Yeah, exactly.
So don't you also have to flesh out the story more about, I can see that data analytics is especially good at new combinations, but that would be true both before and after the IPO.
It is true. Yeah. So our story is that, of course, you can use data analytics to do both type before and after an IPO. The thing is, like, the data analytics skills are very expensive. So now you have this cash infusion from IPO, and where do you want to invest your new cash infusion into? And find that if you choose to invest in data analytics, you get that boost in combinations.
Okay, so there's kind of that the data analytics is done more post-IPO than before pre-IPO.
Yeah, and if you do more of it, exactly. Yeah, right. So yeah, that's kind of the story. So yeah, of course, analytics can help that innovation type, new combinations, regardless IPO status. But because you have, it depends on how much resource you want to invest in data analytics. Before IPO, you may not have enough resources or money financially to hire data scientists, but now you do, and that can help you mitigate that negative effect.
Gotcha.
Yeah. Okay. So we also did a bunch of endogeneity check. So I'm going to briefly mention them. So IPO side, prior literature has done a ton of stuff to figure out that the choice of IPO is obviously endogenous. So they've done. So we did everything literature have asked for, including matching estimators, do a Heckman two-stage estimation to figure out any selection bias on IPO decisions. We also calculate unexpected IPOs to see whether that generates an effect. Unexpected IPOs are the one that have low probability of being gone public, but actually went public. And we find none of these matters in our estimation. So this is a repeat. This is a replication of existing studies. But in our study, we also need to worry about the endogeneity and data analytics, like to what extent, the data analytics decisions, is a choice as opposed to that may affect innovation as opposed to the causality that we're trying to understand is whether data analytics actually help post-IPO firms to innovate better. So here we use a version of a Houseman instrument. So here we're looking at a network of firms. So this is, since we have resume data, so we can actually look at who hired who. So imagine you hear firm A and you hire from these three firms, 1, 2, and B. Okay, and let's say B started to hire a firm C. Okay, that happened to hire a bunch of people that are outside their networks. So A didn't do anything, but the fact that B has hired C and from C, that's automatically, they kind of automatically brought in a network of hires for A without A doing anything. Okay, so that's like so looking at the data skills of neighbors, and here C, we actually look at C as in basically if C also adopted a major AI or data analytics technology. Here we use ERP implementation because those firms tend to be very data intensive. They had to change their processes and capture all kinds of data. So that provides a shock on C in terms of the data analytics skills they may need, and that indirectly affects A's access to the pool of data analytics skills. So we use that like basically distortion to instrument for A's access to data analytics skills. So not surprising, it's the results are pretty consistent across different ways. So we lost some significance in the global tech, but our main story that data analytics helps post-IPO firms, it's the same. So here we use pretty much everything we can think of to address the causality. But again, I think our stronger causality is still the fact that there are different signs it shows our results and our artifacts and statistical artifacts, but actually come from the data analytics helps post-IPO firms to find new combinations.
Yeah, that makes sense. There are a couple of questions about this part. Can I pass those on?
Yeah.
So Daphne Dembo asks about which patents you're taking into account, whether you take into account patents from acquisitions of smaller companies post-IPO, or can you separate out which are patents that they did internally versus that they acquired?
Yeah, it's actually very hard to do. So we did some of that, and we didn't see that acquisition to be a big impact, but other work have shown that to be the case. So we're still in the process of refining that. But here, just all patent you have together. Yeah.
Okay. And Sarah Bana, speaking of which, you mentioned her earlier, she asked earlier about whether you could do a placebo test to look at the timing and mitigate some of the endogeneity concerns that way.
Oh, that's a great idea. Well, I should. I think I'll check if we've done that. We have done a bunch of things, but I'm not sure I've done that precisely.
Yeah. No, you're doing a bunch of things here, and it is pretty consistent. But yeah, you can add one more to the toolkit. Yeah.
Absolutely, but I think it's a good idea. Yeah. And here we'll look at AI specifically, and it shows similar results. But look at the magnitude of AI. It's like almost 10 times of the effect of data analytics. Right? It's analytics 0.092, 0.0296, and then 0.371. So making you think that AI is actually even have a greater effect on this issue. So it makes me more excited to delve deeper in the future work on how AI has a particular effect on this phenomena. But here we have a little shorter data because we only can cover about fewer years in our resume data.
Right, it's not exactly a matched sample, right? So
exactly, right. So now we're going to look through, which mechanism has the most effect from the analytics. Remember earlier I mentioned 3 main factors: short-term financial pressure, okay, and that is to satisfy quarterly earnings, disclosure requirement. You had to disclose a lot more if you're as a public firms, and a managerial incentive, can also be changed after IPO. So let's look at short-term financial pressure first. Again, this has come from this is a metric that others have used in the accounting and for corporate finance literature. Basically, they see that if firms simultaneously report greater than normal profit and lower than normal marketing and lower than normal R&D spending, they are likely to be engaging in myopic management for short-term financial gains. So again, it's like greater to normal profits, but lower marketing and lower R&D expense. So the firm are likely to maximizing short-term financial gains over long-term ones. Okay, so here we measure exactly using this, and we create a variable called myopic. That's identifying firm that match these 3 criteria. Okay, here we see that indeed that data helps myopic firms to alleviate that problem, right? So if you think about that, they have to they have to reduce the length of the innovation, right? Because long-term innovation, risky innovation is harder to it's not good for earnings. But if data analytics can accelerate that process to some extent, then that could help the myopic firms to innovate better. So we see that's the case for new combinations. Again, it's like the type of precisely the type of innovation analytics is supposed to help. Again, we see not the case for new technology that's globally new to the world. Okay, and then we're going to take a look at the disclosure requirements, like looking at public firms that face greater disclosure requirement, because that would dissipate the rent from the innovation. They cannot capture all of it if they had to disclose, especially disclosing early. So here we look at a variable called VC-backed firms, because for VC-backed firms, they already have to disclose more information, right? So because to get VC financing, these firms had to just disclose more information to investors, and that already gave them a risk, because VCs, being a small community, may choose to share that information with competitors. And that's basically you lose some control of that information when you share with the VC community. And that research has also shown that these firms, that's for a firm like this, they face disclosure cost. So we use a measure of whether a firm received venture financing as the variable to measure the disclosure cost. And we also use the total VC financing, and then we see consistent result. We choose to use a binary one because obviously certain type of firm would require more VC financing than others. We didn't want to use that to bias our result. So here just simply a binary variable indicating whether a firm has received VC financing. And here we see that again, that data analytics interact with VC-backed firms. They are more likely to innovate technology that are new combinations, okay, that are new to the local firm. So that shows that data analytics can potentially mitigate some of that effect. And obviously, there's many different ways to measure disclosure cost. So we actually look at, we don't want to, this variable to be biased just for VC firms. We also look at some industry effect, because we believe that disclosure costs are going to be very high for industries with long product cycles, like biopharma firms, energy, etc. And that cost is going to be relatively low for industry with fast production cycle, right? Like electronics. So if our hypothesis is correct, then we would expect that analytics effect in reducing that disclosure cost to be much higher for industry with long product cycle than for firms with faster product cycles. So it means we expect the disclosure cost mitigating by analytics to be higher for these long product cycle industry in biopharma energy than relatively to electronics. So let's see that were the case. So we did a specific industry studies. We look at energy, biopharma, and electronics. Remember, these two have very long product cycle, and this one have relatively short product cycle. And indeed, we see that data analytics, interacting with VC back, processing for disclosure costs, was really have a prominent effect on energy and biopharma, and has almost zero effect on electronics. This is not insignificant, but the size effect is much lower, like 0.1, 0.2, versus energy is 0.12 and 0.14. And pharma is also about 6 times greater than the electronic industries. Okay, so it gave us another indication showing that it's really about data, helping reduction of the effect of that disclosure cost. That's primarily responsible for the effects we see. Okay, and lastly, you look at in managerial incentives. So literature have shown that entrenched managers, like whose jobs are really secure, are more likely to innovate. So a particular metric we want to use is CEO chaired. Basically, the CEO is also the chairman of the board during public status. Okay, so if that was the case, then you have entrenched manager, and then they would be more likely to innovate. But if you have an unentrenched manager or opposite of that, then you could potentially see a significant decline in innovation following an IPO. So we look at CEO chair, and we did not see an effect. Data analytics doesn't help you with that. Again, the incentive is like motivations, right? So it's something that data analytics just cannot help you to do. It also makes sense because you cannot, CEOs or chairman board prerogatives are not going to be easily changed by technologies. So here we see that at least a third mechanism, we do not see any effect from analytics in terms of reducing the effect of entrenched management and broader managerial incentives. Okay, so we'll put them all together. Okay, we'll put in CEO chaired, myopic firms, short-termism, and then VC backed. Again, we see that across all these effects, we see that the most effects coming from new combination locally to the firm, and primarily reducing the cost of myopic firms and cost of disclosure, but not for the incentives in manager incentives for CEO chaired variable. Okay, so and it's like, so well, if you believe analytics is really helping IPO firms to innovate, and you would expect that maybe some firm have caught on to that and would hire more data analytics skills. And here is the data analytics skills acquisition over time. So again, here is 0, okay? The first 3 bars are years before IPO, and the last 5 bars are years after IPO. You can see that, it's really after post-IPO, firms really started ramping up the hiring of data analytics. And that kind of confirms our view that maybe firms are using analytics as a way to reduce that innovation decline. Analytics can potentially help firms stem that decline. Okay. So lastly, I just want to conclude that we show that IPO reduced innovation, and especially for new combination of technologies. So that's conforming to existing literatures. And specifically, we found that data analytics can offset that reduction in innovation, especially for the type that are new combinations of existing technologies. And we found that among the 3 factors that deters innovation for post-IPO firms, analytics primarily helps with myopic firms that focusing on short-term innovation and also information disclosure. So these are things that really a detriment to firm investing in long-term risky innovations. But we didn't see any effect on analytics affecting managerial incentives. So that may not be a surprise, given that these CEO incentives are just very hard to change based on the technology. And we also see that, at least in our recent analysis, it's still relatively preliminary, but we see AI's effect actually much greater even than what data analytics can offer. So we're optimistically hopeful that instead of using costly financial restructuring, firm could potentially direct that capital or cash infusion from analytics and use that to hire data analytics talent, and that may help firm innovate better post-IPO. So that's all.
Thank you.
Yeah.
Thanks. That was a terrific, amazing paper, characteristically very thorough on lots of stuff, and hopefully we have a few more comments here about other suggestions. There are some comments in the Q&A, but before we get to, and I encourage others to feel free to add your questions to the Q&A. Before we get to those, I just wanted to, the second to last, the last bar chart you had, I think that helps me understand better my earlier question about what's different post-IPO versus pre-IPO. I mean, you might put that up earlier as one of the things, as sort of motivation that people. And I don't think that they're doing the analytics just for innovation. I mean, they're doing it for a bunch of reasons, but it seems to help with that. But let's turn to some of the questions. So Chuck Easley has a question. Earlier there's a question about the acquisition and how that might affect the patent mix, but Chuck asks, a lot of companies use IPA proceeds. Also, they may have the companies that they hire may have a different threshold for patent. The companies they acquire may have a different threshold for patenting, or have some unpatented technologies that they can now bring out for patents. Many of these recent startups may be using AI, and he gives some examples of Apple acquiring Perceptio and others. So what are your thoughts on that, about how the firms that IPO may lead to this acquisition of talent, not just patents?
Yeah, I think I'm not ruling that part out. I think that might be a mechanism. I think that, and I think it doesn't distract our story at all. It actually complements our story, what's really going on, because that talent is precisely what drives this type of innovation. But I think as Chuck and other innovation scholars have known, measuring innovation other than patents is really, really hard. And if you guys have any better ideas, and we're trying to get some products, product SKU code to see how they differ. But we're process of seeing that, but or any other type of open source, I don't know.
I think that'd be a great idea, because I mean, you could also imagine that the firm changes the kinds of innovation more than I mean, you're describing it as more innovation. Maybe they're moving, maybe they're changing the kinds of innovations they're doing, and that's sort of a related but complementary way of interpreting things, particularly the decline in innovation that you showed in your first few slides. I mean, that could also be that patents are especially important for private companies. They need to get investors and have IP, and maybe public companies have other ways of protecting some of their innovations.
Right, so that problem has been addressed a little bit by the corporate finance literature. They look at more of the different types, and they see generally the decline in quality, not just the type. Yeah.
Okay, that makes sense. Bill DeSir has a question. Did you analyze or compare across industry types, like, asset heavy or asset light, or the ones that are more digital or less digital? So other ways of slicing the data.
Yeah, a great way. We mostly just looking at what makes IPO costly. So we're mostly looking at the product cycle as a primary way to dissect it. But I think that's a great way. Our analysis partially addressed that because we do control for industry, and we do have firm fixed effects that take away some of the industry specific characteristics. But I think just generally looking at the digital enabled and digital ready firms versus non-digital ready firms may be a great way to further reveal some interesting findings. But I thank you for that suggestion.
Okay. Bertrand Quibuca asks, what do you think of the situation after short-term financial gains hype? Some firms may get investors by promising innovations and huge gains and then they lose attention to innovation after a certain period of time. What do you think happens in this case, being acquired or just completely changing the primary industry?
So this is something I think David Shu and others have addressed, and they also look at merger and acquisition after IPO, like see what, not just IPO, but also merger acquisitions, and they see similar effects, but smaller than a pure IPO one, because IPO one is like a really massive dump of information, disclosing a lot of information out there. But merger and acquisition is in between, so they definitely see some of that intermediate effect. But I think regardless of that effect, I think the analytics primarily helps you with new combinations, and I think regardless of merger and acquisition or IPO, you're going to see that effects throughout.
Gotcha. Rodrigo Barros has a question that we're all interested in. Where can we get the full paper, please? I can put that in the chat, and if you want to share the slides, we'd be happy to share those.
Absolutely. I will send you an email. We're still revising the paper, but I'll put a prior version of that paper up.
Okay. Is there something available like that the folks here can have access to?
Yeah, I don't have it off, and I can't put a chat right now. It's just not good at chat yet, but I will definitely send to you.
If it's okay, I'll tell people we'll put it on our website.
Yeah, absolutely.
We'll put a link to it on the website by your talk, and anything else you want to share.
Yeah, absolutely.
Okay, great. Yorgos Petropoulos asks, do you have an explanation about the fact that firms tend to acquire more data analytics skills after the IPO? Is it because of the financial constraints beforehand, or you said earlier that they get more money? And I'm going to bundle that with another question from Chuck, which is, what about hiring for other skills relative to data analytics? So, I mean, I think you showed a bump in data analytics hiring. Is that in absolute terms or relative terms, both? Is it cutting edge skills in general is being hired for? So maybe you can say a little bit more about those two questions.
Yeah, that's a great question. So the first one is relative to other skills. So we did both the raw number and also the percentage of employees have data analytics skills, and we see that both increasing quite a bit post IPO. So gave us ideas, not just a relatively just firm hire a bunch of other people in addition to the analytics. It's really about the analytics skills
switching over in that direction.
Yeah. And I didn't really quite get Yorgos' question.
So his question, well, it's a natural follow-up. Is do you have an explanation for why that would be? Why would they hire more data analytics relative to other people?
Oh yeah, I don't have a. I think that's a research project of its own to see why firm hire analytics in the first place. And I think it's a broader research area. I think is really important for us to know. Like we see firms acquire AI skills, data analytics skills, but I actually don't know specifically what they do with it, right? I mean, we hear some canonical examples, but I haven't been able to find out,
right. Well, in particular, after IPO, I mean, I could speculate. I mean, you could imagine that pre-IPO, you kind of have to like do something really original to get funding, do something new, and then once after IPO, maybe you want to like build on your, now you've got something going and you want to sort of build on. So there's kind of a complementarity in both directions. I mean, you described it as the analytics allow you to do more of this combinatorial innovation, which makes a lot of sense. But you could also flip it around and say if you had a strategy of doing more combinatorial innovation, you would hire more analytics people. and so they may be complementary. And I know you've written quite a bit on complementarities as well.
Yeah, that's great. Great way to spin it. I love that explanation. But I also I fully agree with that. And I think it's in our result we see that if you look at when I look at different type of innovation and we're being IPO effects, it's primarily affecting just one category of innovation, which is the new combinations. It didn't affect new tech. It didn't affect incremental, innovation. It really just affect that local, new combination that are relatively new to the firm, and that seems to have the most detrimental effect. And that's precisely the one that analytics can help you address. And for that particular regression, is almost mitigate all of it. But of course, it doesn't mitigate all type of innovations, right? But for that particular type, that's happened to be the one that IPO has the most effect on, and also the one that analytics can help the most. So that gives me an optimistic view about this. Yeah.
We're almost out of time. So Brynjolfsson Kwipuka has another question, but this is much broader. I don't know if you want to take a crack at this one. What are some AI solutions to the problem of the speculation-driven investment on Wall Street? And is AI going to help with that? Feel free to speculate yourself on that one.
That's a great research question. I mean, I think somebody should do that, looking at startups, looking at how AI inflates the value for these startups.
But also maybe identifying which ones, are I mean, it's being used by investors as well to try to maybe make a difference.
Right. Maybe that's why I see the AI effects of 10x of data analytics. Maybe inflation is part of it. I don't know. but I think it's definitely a really important question for us to understand. And that changed firm strategy quite a bit, especially we see so many firms these days just attach AI to their business plan. And maybe that has something about signaling effects on the valuation.
Well, great, Lynn, this is a terrific paper. It's really it's so rich, and you were very careful about checking a lot of the different hypotheses, and it looks like your results are very robust. So we're looking forward to having you share the full paper with us when it's ready. We'll put it on our website. Thanks very much for coming and joining us and speaking today.
Thank you so much. I had so much fun here. I didn't even realize time was up. Thank you so much.
Yeah, it's great. And next week we have Laura Veldkamp. She's going to be speaking about data and market power. So please sign up for that seminar, and look forward to seeing you all then. Thanks again, Lynn. It was a real pleasure seeing you. Always a pleasure seeing you. And thanks for sharing the research with us.
Thank you.
Bye.
Bye-bye.